Yo and hello. Hi everyone, this is Niaz again, back with our next installment of going over the market. So I figured, I've been kind of meaning to do this kind of a video for some time, like, just going over like in the background of the market, what's happening, kind of like give you, I guess, like an update. And I actually made one of these videos over the weekend, but I was kind of was hanging outside for some time and I wasn't in the right mind, let's say, right? So I don't know, it didn't come off as maybe professional. No, not that any of these things I'm doing is that professional anyway to begin with, but it was especially unprofessional, let's say. So I figured, you know what, let's do something today because with all the data that we've been seeing coming out, and we have officially hit the earnings season, and I think that there are a lot of things that are happening in the market that that are interesting to note. So that's it. I guess let's start off with like I think like last time I did any kind of update was like about a couple of weeks ago, maybe 3 weeks back. I think since then a lot of things has happened from both a fundamental and a technical perspective. And obviously our world that we live in is being really a something that's really been um, we're going through some like really important like inflection points in the market, right? Driven by not just underlying reasons, obviously with COVID, with the lockdowns, with stimulus after COVID, massive amount of stimulus now there. I mean, it's not rocket science. They stimulate a lot. Now they're trying to take, that excess off. And in order to do so, there's basically, markets go down whenever you do that. It's not rocket science. And so that's exactly what happened. And the question is that when is there, are there more to go? How long will it be down and things like that? Where is it that we're gonna hit the bottom? Those are hard to answer, but this is not exactly like, let's say, a surprise of rocket science that, hey, if you think about it for 2 seconds, that, hey, like they put a lot of money in and now they're trying to jack up the interest rates. That's just less credit available. If there's less credit available, the financing portion of for companies gets harder, right? So even compared to like 3 months back now, if a company goes out there to get a loan, it's going to be a lot more expensive. Then the question becomes like, how do they service their previous loans, right? 'Cause a lot of companies are in that boat now. So anyway, so that's something, kind of look over kind of a macro view, and then kind of maybe set some expectation or maybe speculate into the future what might be possible. So let's take a look at a few of the things that has happened. This week is very important, and this for, we're gonna look at that first. All right. So this is basically SPX. I'm gonna try to take the technicals off first because market will be opening in about uh, 12 minutes. So um, basically, I mean, we've been looking at the market. I think last time we looked, it was like right around this corner when it was kind of hitting a small little bounce, small like a 3-day base over here. And what happened was, and I was tweeting about this, like where this became an important level that 38. What is this? 38. Yeah, 27 or so. And then it once it broke up because it broke up with pretty. It's not like the most strongest chart pattern, but enough to kind of have a little bounce and rolled over. Like I said, it's not the strongest chart pattern right here. Um, Ideally, you want to kind of see some a little bit more basing. You want to see like more kind of price action that signifies a little bit more capitulation, right? Like let's say like a doji or a hammer or something like that, and then kind of a consolidation and kind of move up. So, but I mean, for what it is, this goes to show like essentially there's a wide, like um, range, and so prices have been stabilized, and so it's still going through the gyrations of what seems to be a regular bear market, rebound. So there's two things technical that we can think of. I think that essentially, if this level holds, which is about 37 45, I thought it was 37.38, isn't it? There you go. Yeah, 37.38 was the ultimate low here. But you get the gist about this area is if this holds, then we have one the low here, another low, and this if this holds, there's a chance that we might have a little bit of a summer rally. This is something I've been kind of you know uh, maybe expecting. I mean, we already had from the lows over here from 36 to 39, whatever, 27, a small rally, but nothing sustained, and so, but um, it, 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 if this holds, we might see something of like, a small, maybe summer rally, right? Uh, and like I said, we kind of due for it, maybe like a few month, month or two, right? Something like that, right? Because we've been in a 6 month long bear market, really, if you count from like end of like December, right? So, but then this leg has been since like April all the way down. But the gist of what I'm saying here is that um, usually if it's something goes that fast, I mean, we see some rally kind of lasting a little bit longer, so something like this maybe, but we haven't seen one yet. Um, and the yeah, and the if you look at the chart, also something that will kind of that's kind of different is that if you look at the lows here, the lows keep on like, you know, oh, come on, at 36.36 and 37.38 or whatever that thing was, right? Um, Okay. Yeah, and 36, 7, 38, something's interesting is that you can see like a pattern that where you have in an intermediate sense, in a couple of weeks you had two higher ups, right? And this happened like early, like, early in the year, like over here, right? And there was, it led to a pretty good bounce. And this is something that, I was maybe expecting, but this price action uh, is it's a positive note, right? That's a like a point for a possible bullish scenario, even if a short-term bullish maybe, right? And so that's something that you can see there's two clear pivots on the they're both going up. On the other hand, though, you have the highs are like the latest highs lower than the previous high, the pivot highs, which kind of signifies, I mean, technically speaking, this is a sideways market, by the book, but at least if you look at the lows, it's somewhat more bullish. But you have to wait for the perfect signal, right? Or the most optimum signal. Now, what this thing signifies, in my opinion, more likely is that it's just a short bear market rally and a sideways market before we head down again. Because, I mean, clearly we're in a bear market, right? Boom. One of the trick is that if you want to really, really simplify things, maybe too simple, is just to take a look at where the chart is. If you look at a chart, it's from the top left to the bottom right. It's a downtrend, and it's pretty simple as that, I guess. And my technical analysis, if you haven't figured it by now, is very like bare bones. So I want to know dynamic market like psychology, just simple price action. That tells me everything I need to know, like strength, weakness, convergence point, consolidation, breakouts, breakdowns, inflection points, trigger areas and pivot zones, important zones of, like sideways market, stuff like that, right? So in many ways, like I don't really depend on even like obviously I don't use any kind of signals or indicators or anything like that. Secondary indicators. I just look at price, volume, where the levels are at, at max when it comes to like technical analysis, like using other things, it'll be just like drawing very general lines and channels and things like that. And also moving averages, really that's the thing. Moving averages can also work as a signal, but also generally kind of give you an idea, about general trend. But anyway, so my point in showing all that is basically, I mean, on one hand, there's some bullish aspect of price action. Maybe this will lead into the next leg down. We might see a better bullish setup for a rally, but this doesn't look like it. It's panning out to be a rally, right? And So that's something important to understand. Now, one thing is also kind of looking at the price action is this was something that was has been really happening is that this price level about 39 uh, it had 39. We're gonna just leave that off the 39.44 here. Technically, even though that was the pivot high, I mean, if you look at it over here, 39.24 has been kind of like the level where you have a lot of like action happening. So, one, two double touches, there's a lot of action. It's been getting rejected early on. It got rejected real bad. You have a low over here. Um, and Then it went up again, right? And looks like, yeah, if a low forms over here and the price breaks up, we will have another small like higher low, right? um, then you have this like resistance line at the top that's coming by again, another inflection point. So we have a lot of like things that are converging here. So we might see some kind of a whatever happens at this level, it's going to be an important level. Either price will hit this and get rejected and go down, or it will prove itself and move up, and that'll be a signal to maybe get in for another leg to the upside. And then we have basically, if it does go up, we have a gap fill here and basically a general level over here that we should expect at worst at the next area to break. If it moves up, right? If it goes boom, this is the level that we have to look at. We should start to see price slow down once it gets to around here, right? Which is 40.86, and then maybe fight its way over here, and which is 41.65. So if it does break above, what is this, 39.20, 39.20, this was again a level that I was tweeting a lot about this level because this is a very important level. I was kind of again discounting this spike at 39.44. Basically, if it does go up, quite a bit of room to run to like 40.86, like I said, rough thereabouts, 40.80, whatever, and all the way up to 41.65 is going to be the kind of congestion area, or should be the congestion area. If it moves and breaks 41.65, then hallelujah. Um, so that's going to be the bullish scenario. The bearish scenario is that if this gets broken and kind of moves down again, really we have one, two, three. So we have intermediate term, like short term, not intermediate exactly, short term here. If it does break, let's say it moves up and it gets rejected. I mean, if it breaks this low here and kind of keeps on moving down, then we know our answer, right? It's probably going to be we have to wait for it to break 36.36 to know, but it's probably going to be a down market, right? If it breaks this level, um, because it goes down to, I think it was 37.60. 37.67 was actually what kind of a level I was looking at before. That was intraday was important on this day, which was 13th. No, that's not 13th. Oh yeah, 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 it is 13th. Yeah, my bad. I'm looking at the hourly. I'm sorry. uh, so um, so yeah, no wonder, duh. Um, and so yeah, this was a level that was important before 36, so 37.67. But basically the low here is the 37.60, 59. We'll just chalk it up to 59. But anyway, if it does break, not a strong level here at 37.59 because it hasn't had multiple touches. It's really we're keying off of 37.38 or so. Let's just say 37.40. Oops, there go the market. I'm sorry. And if it breaks down there, looks like market's gapping down. That's not a good news. JPM came out with their earnings and stuff. I think who else? Here, let's see. We'll look at it. We'll look at it. Yeah, surprise is negative. That is yeah, that is not good. All right, so um, Morgan Stanley, yeah, not good. So this is obviously not good. So we'll just go over the macro and what we might be looking at the macro side of it. But yeah, I mean if it breaks 36.36, which is very much possible, then let's see what happens over here. We might just be going down with all this bad news coming out. Um, Bias is obviously to the downside. Again, like I've been saying, it's a bear market, right? So if this breaks over here with 37.38 with good strength, then um, it's actually pretty fairly strong level. That's a moderately strong level. And then 36.36 in the next one, next leg down. If it breaks there, then hallelujah. Then we have quite a bit. We technically speaking, with the next leg down, it's going to be here, right about uh, 3,500 or so. We start to enter the next leg of like compression or congestion zone, and really our big area to look at, the next um, kind of a trigger point would be the 32.28 or so. Just chalk it down to 32.25. All right, 32 and a quarter hundred. So basically, if 36.36 gets violated, we have 3,500. Technically speaking, it is technically speaking. Let's just say about what is this? Okay, so that'll be 35.35. So easy 100 points. That should be a quick, flush down, and then from that point on, we have 32, 32. Again, rough estimation. Again, you don't have to be perfect. 32.30, let's say. And if it does break 32.30, then voila, we still have ways to go. So yeah, I mean, the thing is, unlike in a market, the direction it takes, if there's no if there's no train stop, right, um, it has room to run. So if it breaks 36.36, there hasn't been, we're making new lows. It has to stop and prove itself before we can say, hey, the lows are over. So now, we have to look at now technically, that's the technical side of it, and I'm only looking at the primary, the equity market here. Um, I think and this is some of my the first videos that I made. I was like going over what I, kind of posited, and again, these are speculation that what might be happening in the market, and my expectation was the market will be we're in a bear market, and the first leg of the down move was based off of inflation fears, and and the market not basically being unsatisfied with the Fed and their reaction to it. um, I think now I said the thing is that it is a bear market, if not a recession. If it's a recession, we're looking for some time down in a bear market zone, and we're looking for more of a grinding kind of a bear market, right? Whereas if it's a regular bear market, about 6 months to a year, then it's something that happens, and we should see some kind of a rebound. Now, I don't know to what extent. I mean, technically, we are in a recession, but we don't haven't really seen like all the bad numbers come out yet, right? Obviously, the the jobs market is the last thing that's really holding up and saying that hey, uh, we're not necessarily in a recession because we still have good job numbers, right? Unemployment still like generationally low. So, the, but you have it's to be understood that job market is kind of like a lagging indicator, right? Like that, and that's what the Fed is doing is they're keying off of the job market. But the thing is that if they're lagging behind, right, um, then are they really leading the market, or like they're behind the market, so to speak, right? With high inflation, they haven't been like fixed yet, right? And they have now started to basically say more or less that inflation will probably not be, dealt with anytime soon, which is basically what my thesis was early in the year. That I didn't think that this is, and you know, it's really not reasonable for anyone to expect for inflation to be down. With the small amount of like hikes that we're doing. Um, and so largely that has been proven right. Now, the second leg and my main reason why I thought that after the Fed started to take action and jack up the interest rates because they have to take this seriously at some point, which they started about June or so. Um, last Fed hike. Um, so when they hiked it up to like 3/4 of a point, and they were basically surprised by the CPI numbers before then, right? The Friday before then. And now what happens though is that, and this is something I mentioned, is that when we look at the market, we're basically pricing in profitability of companies, right? And so if you look at the profitability of companies, I mean, theoretically, not theoretically, in many ways, I mean, they were more profitable, right? But then again, they were flush with cash. Um, And so what happened is that the thesis that I had was basically, or what I was positing is that in going into the end of the year, once the Fed starts to take action, then all of a sudden the market has to deal with the fact that hey, they're taking all the easy money away. So what happens then is that the potentiality of companies or businesses, right, or the stock market, equities, uh, for them to be able to in the debt market to raise capital, to kind of like finance their everyday, finance their debt, right, to pay back the old debts, and on top of that to help them operate their business and like operating expenditures and things like that, or capex and stuff like that, if not opex. So these kinds of their ability to gain easy cash will be down. And so what's going to happen is that, well, we're going to see busts, if not at worst busts, but at the minimum lower income, like lesser earnings. And so that hasn't been, I think, priced in yet. Because what happens is that we've been getting all the earnings reports based off of like early in the year where things were relatively better. Since the Fed has been hiking interest rates, we haven't seen those numbers yet till now. And what's going to happen is that the numbers will still be good, but the earnings projection, it all depends on what people are saying. And, more than likely, now that people are getting used to it, there will be, earnings projection will be guided down. And that's the next leg. And that's what you're seeing, in my opinion, is that true, technically speaking, like I said, that we are not, like we don't have a trigger yet to say, okay, we're in the next leg down of the bear market. And you could say that, hey, we have to wait for this to play out, right? This zone, right? And you could say it's a, just like a sideways market, and I would agree with you. But it's been sideways market in the last month, right? But overall, we're speaking of the underlying like environment of the market. And so if our expectation then becomes like, okay, they're going to have bad earnings, then we should expect then the market to tumble because, well, now we're going to be pricing in, oh, holy crap, we got to have bad earnings, and when will they stop hiking rates? The more rates get hiked, it has a kind of like a second order effects, right? It has an effect that goes out all across the market, so to speak, and because funding, everything's based off of liquidity, and you take liquidity out, um, a lot of these companies go, become unstable, right? And so that's basically, what I kind of a crux of the idea that that we were looking at is, what are the possibilities? What will happen once this right hike the interest rates? Now, the other possibilities that people would say that, hey, they're not going to hike it up as much as possible. They're going to overreact. Well, okay, if they don't hike it up, then we have higher inflation. If you have higher inflation, well, people don't buy things, right? Because they have higher need for like basic stuff, right? And because the cost of basic stuff, because everyone's competing over basic stuff rather than expensive goods. So Louis Vuitton will necessarily not be affected, but people who buy Louis Vuitton and stuff like that. But people who buy, let's say, normal consumable items and things of that nature, right? Those kind of people, like the 60% of America, their purchasing power goes down, right? And earnings of different companies, given an inflationary environment, or rapidly inflationary environment, even if they have earnings, compared to basically the uh, this also applies to companies basically, right? The purchasing power of these numbers that they're promote, that they're beating in of themselves, doesn't mean as much, right? Because the companies themselves also lose purchasing power. Okay. Um, so basically, in that kind of a situation, we still, even if people beat earnings, the effect of that is, um, it kind of gets like undercut, right? And and so what that implies is that even if we had higher inflation period, then we would have seen um, earnings take a hit, right? Um, and relative to PE ratio, we would be still looking at, again, this is likely, in my estimation, we don't know 100% because that didn't pan out. That scenario didn't pan out. Or looking to be that that's not going to pan out. The Fed has been very hawkish. The Fed basically changed like almost on a dime. Powell sounds like a different guy like a month back, right? So if the rates weren't hiked, and or they the Fed just says, oh, we're gonna hike this time and that's it. We're gonna wait and see approach or whatever the hell. Um, situation is already kind of beyond their. They have let the situation roll too much beyond their, without dealing with them. So now they're gonna sit back, So they've been kind of changing, their stance. All of a sudden, they're really hawkish about, inflation. Now, all of a sudden, they're gonna say, "Oh, that's like another about face." That also, you know, they're not gonna have that much confidence. I mean, Powell himself is always like till now has been seen, or he looks like, he's all waffles here, there. He never like says anything sticks to 100%, quote unquote, based on the data. He's always behind the data. So now, if he looks like he is, kind of complacent and can't make up his mind again, then all of a sudden that's not, that doesn't give you confidence either. So my point being that essentially, even in a high inflationary environment where inflation outpaces the purchasing power of the currency and outpaces the purchasing power of earnings, essentially, that's not good for you know that's not good for valuation of the stock market, right? Beyond the nominal numbers, and also due to um, higher debt and higher expenditures of the average person, that's not also good for business. Okay. At least for transaction, at least for the consumer is like 70% of America, right? America is a consuming or consumer-based economy, right? They consume. I don't want to go in that rabbit hole, but essentially, if people don't consume, then we're in a problem, right? Money can be cycled, so there's no wealth effect, right? So these things kind of kick in. So Um, so now we're more likely that the Fed, I mean, the Fed even has said that they're going to be jacking up the interest rates. One point, they're willing to do that. And with higher print inflation numbers that are coming out, all these numbers that were kind of macro numbers that are getting bad. Based off of that, we can, if the Fed really sticks to it, and which is, in my opinion, what they will do. Um, because again, if they don't, after like puffing their chest, I mean, it just, I mean, would anyone take their word seriously ever again, right? Um, and so yeah, that's basically what I think is likely to happen. That they're going to be jacking up the interest rates. Um, all right. Um, so I mean, let's do this thing. Like I think till now the PE ratio of S&P was, I think, like 20, right? Or about yeah, 20. 19.91, I think, something like that. But just chalk it up to 20. Um, the historically, I mean, the like a PE ratio that we can say is like normal is about 15, 16, something like that. Now 20 is not terribly bad. I mean, at some point it was close to 30 even. Has gone over 30 for S&P at its highs, and clearly that's not good. So it's not terribly expensive. But in a downtrend, in a down market, market does go down to like 10, 9, right? When you think of like 2008 bear market, those kind of, that's when they companies or stocks becomes cheap. It makes more sense. You buying basically really companies that are producing income, yet they're not priced as such, right? That usually happens in kind of the bottom of a down market, because essentially, and at that point, liquidity is, like there's low liquidity, and all the companies that are still surviving are the companies that are making money, right? And then you can go and swoop in and buy a bunch of them, and wait for valuation to catch up to their PE and and then the same cycle starts again. Um, let's see. Let's 23, whatever. Just take all the stuff off. Okay. Um, and so right now, let's say, so it's about 20, and the earnings PE rate, the EPS on SPX on the aggregate is about $210, right? So if we, let's say, take a 16 PE on $210, that's about 33.60. If we're in a bear market, and let's say we go back to at least medium, or like whatever the average is, which is about, like I said, 15, 16, we're looking at, let's say, 3100 to 3150 to 3350. Okay, which is also, surprise surprise, about 3200 is like what we said before, 3230 or whatever, as like a good area to look at technically, right, in that zone. Now, you know we are not likely to, yeah, so if earnings was at like $210 or so, right? And clearly, in a bear market, earnings EPS takes a hit, right? Our expectation, and this is the problem, is that we're going to be downgrading our future earnings guidance, right? Forward-looking guidance. Um, so if that happens, um, yeah, looks like 37, 36 has been broken. Um, or 37, 38 is at 37, 38 right now. Um, yeah, straight down. Um, And this is what with the earnings coming out, this is basically what we're facing, right? It's a very important time of the uh, month for the market now. Uh, but back to EPS is that if the S&P is in earnings per share is on an aggregate $210, and we expect earnings to go down, let's say it goes down, I don't know, like 30 dollars, right? 180. So if we expect, let's say, a normal valuation of 16, PE ratio at let's say $180, that's about 28.80. Then we're looking still more downside risk, right? Um, if this is a bear market cycle or even a recession cycle, and we have more ways to leg to go, we could possibly go even lower. Now, technically speaking, if it breaks 32.20, man, I mean that's painful. Um, then the next one will be like 29.69, then 27.64, then really not a whole lot of space till you hit like 22 something, whatever, 23, 30, 43. That little, this is daily, right? Okay, yeah, that we're gonna discount this hammer, more like a mace hammer. All right, so yeah, 2300. Well, let's just chalk it up to 2300. Um, so that's basically looking at the future, the future as we see more downgrades. If you really price the market, according to um, earnings, and that's what the market really is. It's earnings, right? We're buying or selling future earnings potential of companies. Then yeah, I mean we still have some ways to go, and also with the earnings that are coming out, right? Oh, there you go. Okay, so this is earnings, aggregate earnings, PE, sorry, EPS for S&P, right? You can see that said, well, I thought it was 207. I think this is lagging a little bit. It should be 207 something, but um, 210 in December. Whatever, you get the gist of it. So anyway, so you look at the numbers, and let's look at the macro numbers, and basically what's one thing people don't, I think, underestimate is the NFIB numbers, because those are basically like small businesses, medium businesses, and based on the optimism, basically what they kind of in some ways predict other macro numbers because they're more deep in the business cycle, and so if they really feel the hurt, it gets affected and shown up in like the macro numbers later on, right? Especially like jobs numbers and things like that. So obviously it came in lower, so that's, well, bad, right? Consistently going lower. um, we have mortgage rates are going up. So that's something that that's something I haven't talked about yet, and maybe I will do something later, going over the housing market, because I think the housing market is basically, I mean, we all know it's getting lagging and getting behind, but I think we're about to see some fireworks there. That's the next leg. That's an important leg. Inflation rate was the big shocker, or not exactly shocker if you're keeping up with things. Um, Applications on mortgages are down, like you can see generally. Like July, it's down only 1.7%, but you have to understand in July it should have been higher because we should be getting more loans, because this is like the time of the year that people look at houses and buy houses and things like that. Inflation rate keeps on moving up. They haven't done anything about it. Um, Core inflation is basically something that it's kind of like leading, because that's the back end of it, right? Um, and and so that's basically, again, we're trending higher. It it was more 0.1% more than in an estimate. Now the big thing is CPI for June, again higher, right? Um, PPI came out, and PPI was again high. This was today in the morning. Core PPI higher, in jobless claims slightly higher. Jobless claims is again, like I said, it's like the last leg to fall. It's been trending higher, even though in absolute terms it's lower than normal, but still, it's trending higher. Uh, and if that's the one thing that they're keying off of, that's like the one data that kind of behind, that they're keying off of. PPI numbers again higher. Basically, that's producer purchase, and this is gonna affect consumer purchase because that hasn't been translated onto the consumer yet. Core PPI again, but 1.1%. If you have like most data that are bad, it's one piece of data actually that's good. But anyway, you get the gist of it. Now we have to look at also earnings. You know what? Let's look at TOS earnings. So never mind. Let's just go look at. Oh yeah, Fed fund rate. That's something to be. If you look at the Fed watch tool, where the market is expecting, it went from like 35, 75 basis points now to 1 basis point, literal 100 basis points, a whole point, right? So now 83% chance that the market, the futures, Fed futures market is expecting 83% chance the next Fed meeting that it's going to be they're going to hike it up to 1 whole point. So again, if that happens, that basically means that's going to put the hurt on you know uh, on the equities market, right? On risk assets. Risk will be off again, even more off than it's right now. So yeah, last bit is wanted to go over the earnings, and if you look at it, JPM surprise earnings came out today. And this kicks off the earnings season. The big financial names. You got JPM again, surprise to the downside. Morgan Stanley surprise to the downside. Um, we have a lot of PNC, I believe, is coming out today. I thought they're coming out today. Okay, I guess the two big ones are out. Um, TSM. This is something important to look at is Taiwan Semiconductor or any kind of semiconductor because our quote unquote modern economy is based off of semiconductors, right? And so this kind of like base forms the basis of gives you an idea of how the market might react or consumers are reacting or economic activity is reacting. And so if the earnings are bad, remember also they're reporting numbers previous and before like all this interest rate cuts. I mean interest rate hikes, right? So 3.3 is good, but I mean, is it really that good? I mean, if all the other type of people are coming out with bad numbers. Now, again, let's see, TSM. Um, yeah, I mean, they've been on an upswing for some time. The earnings, they've been beating the expectation. So 3.3 is not exactly surprising or anything like that for him, but uh, if you look at the financials, that tells you that essentially, um, that e- essentially, that they're in the business of money or funding or making money or, loans and stuff like that, and so it's going to be canary in the man. I can never say that word in the coal mine, so to speak, to figure out. Um, uh, you know, uh, the financial situation, the kind of like the situation of liquidity and capital in the overall economy, and that's kind of why it's important to take a look at the financials first. One thing that with the higher interest rates that should be positive for banks because of the deposits, right? They're making a higher percentage on it. But it's important to take a look at things like like commercial banks or like especially consumer banks, doing a lot of consumer loans like Wells Fargo and people like them to get a feel for okay, what are the projections? And I haven't looked through all the like guidance through all the financial ones, finance stocks, but it's important to take a look at the guidance on the banks to kind of get a maybe feel for um, what they expect, right? At the end of the day, these people are on the front line of like the whole liquidity capital in the whole economy. So I'll leave it at that, really. Anyway, so that's I guess kind of long-winded. Um, that is going to be like 10, 20 minutes. It's like 45 minutes in. Jesus. So yeah, market. Let's take a look at in a month. No, yeah, look, it's going down with strength. Yeah, that's one of the things you were looking at. One thing, technically speaking, I was going to comment on is whenever we saw the market or S&P like around this 30 uh, the 38 like 20 level or intraday you were looking at it, yeah, when it went to the 39 like 27, that's also an important level here that we were looking at. It never could break it, right? One of the funny thing or one of the interesting things was that the market would always rebound, right? It will always like um, even if it kind of breaks out in the morning, they will always rebound and show strength into the close. Sometimes it will do a fade, but for like a week or so, like over here, they were like just basically no, not over here. Yeah, right around here, like in both cases, like even sometimes they would fade, but more often than not, they would still hold their strength. Um, and we have to see whether that same thing stays true here. But look, I mean, it's going down with strength. You have a huge gap down. It's breaking. The downside is, it's to the downside with quite a bit of strength. Look, I mean, it's just red, red, red. You have a quick bounce up. It's going red again. So there you go. I mean, I'm pretty, I made quite a bit of chunk in the last few weeks. So um, I might be trading a little bit more, now that I know what the market's headed. I had some orders to go through. So um, yeah, basically, that's really it. Looks like as of right now, again, the bias, we might see some kind of a sideways market in the short term. If it, like I said, breaks up above that, whatever that level was, the 32, 38, 20 something, right? 25, let's say, then 39, 20 or so. So it has to prove itself. I mean, now price has gone below the last pivot low of 37, 38, right? On good, it has gone below and punched right through with good strength. So again, that's a bearish sign. So um, yeah, it again, it might go sideways. It might go up and then kind of like punch through that this resistance line that I had before. Which one was it? Uh, I'm just gonna redo my tables here after I'm done with the video. But yeah, then it has to prove itself. It has to do a lot more work here to prove itself to go to the upside, right? It has to do more work to like undo the damage. So there's more work to be done to go to the upside rather than to the downside. Now the next leg, they just have one leg to go, which is 36.36. Technically speaking, this is looking to be again. We might be entering bearish kind of a trend again. And again, it looks to me a bear market. I was looking out for maybe a better or bigger like a counter trend. we still might see some, right? Again, you never want to write it of anything. If the market trends, it doesn't trend and goes sideways for some time, it might be putting a base consolidation period for us to see a you know significant rally then, because if it does base for a long time, it takes away momentum from the downside, and we're likely to see something of a I wouldn't expect that, right? My bias is that we're in a bear market. If that really happens, that will really cause me to then question my bias. And again, as a trader, you have to be flexible to you know change with the times. It's like the season something. You don't like question if it's raining or if it's like I don't know hot as hell in Texas like right now. But if things change, you have to change with it. Um, but looking at the market, it's a bear market. That will be the expectation. My trigger to put a big position would be 36.36 intraday. I'm trading either way, wherever it goes. My bias still to the downside, right? Um, and and yeah, like I said, but you still have to keep your eyes open for a kind of a consolidation or a rebound. If it does consolidate at this point, if it consolidates, it doesn't go down. That's a pretty strong. I wouldn't say pretty strong, but might be something to look out for. Might lead into a consolidation. If it's an elongated consolidation, then yeah, um, some of my biases, I would have to again rethink, because if the consolidation goes for a long time, maybe the bear market's over and we're headed for a uh, up move again. Again, that's not my bias. Price has to prove itself. More than likely, we're seeing a next leg down. Um, but yeah, if it breaks 36.36, then uh, you know, we're looking quite a bit of distance, quite a bit of room to run, because there's quite a bit of room to run, because you have to look at 36.36 was the pivot. It goes way back in 2020, late 2020. That pivot was again that 30. Here, let's go see. So 37, 36, almost like it was the same pivot in 2020, and then 36, 36 was uh, it was like a starting of a congestion zone or so again in 2020, late 2020. But those are not necessarily very strong levels, right? Um, so yeah, I mean, really, we start to like uh, that there's quite a bit of space to run. Basically, that's the gist of it. If it does break down, and today it looks, it's going down with pretty good strength. All right, I'll leave it at this. I thought again it was a 20-minute video. Now it's like freaking 52-minute video. It's like a like I just did a speech here. Anyway, yeah, I gotta get back to checking my positions and look at my orders, and um, I'm probably not gonna trade like today. Like I'm putting some big, longer term orders, but I'm probably not gonna trade intraday today. So, oh, one last thing, I guess before I go, we have to look at the dollar. Jesus, I forgot. What else am I forgetting? I don't know. So the dollar, I mean, it's just going to the moon, and this is again another thing is that people are going to dollar as safety. So that's something you have to be aware of, the correlation, because now the correlation is that and this is something what you'd expect, flight to quality. Overseas markets are all effed up, right? And so what they're doing is people are basically going to dollar as as flight to quality. As look, I mean, you can see that the dollar was clearly like on a triangle pattern. You also have like a bull flag type of pattern here. It's a continuation pattern, and boom, it went up. But the main macro reason is that basically everyone's piling onto dollar as this, as a safety vehicle, right? And so our we should have basically, you can think it is a pairs trade. You can think of dollar running inverse of the regular market. So if the dollar kind of starts to behave differently, we might expect different behavior in the regular markets too. But the underlying reason that everything's moving the dollar is that it's fear, it's a flight to safety, it's a flight to quality. People are it's a safe haven trade right now. So when the safe haven trade is gone, then we have to ask ourselves, where's the money leaving? Chances are, then risk on is going to be on, right? Right now, risk is off. People are driving into dollars. When risk is on, then we should expect dollars to for people to move out of dollar, and then sorry, risk is off right now. Man, I'm babbling now. Risk is off right now, so therefore they're moving to dollars. So when risk is on, they will get out of dollars and go into risky, quote unquote risky um, uh, assets like stocks, right? So that's a relationship that you have to look at. This is not just the U.S. market. This is the whole world, right? Because the dollar is basically kind of like the via media the world uses, um, not just to like transact, but also to like for funding purposes, right? And also as a short term vehicle to stay in, depending on how the market goes. So and Also, the 10-year will be also something to take a look at. Let's look at TNX. As you can see, the TNX, the rates are going down. So people are piling onto the 10-year. Again, this is another sign that people are expecting some kind of a recession type environment, right? Because people are piling onto fixed income, again, as a safety vehicle, and getting out of risky assets and theoretically trying to capture as much yield as possible, and kind of preempting the market, right? So let's see what happens here, and yeah. So again, I don't want to keep on babbling. It's now a bit like, holy crap! It's 56 minutes or 57 minutes. So I guess I'll leave that be, and yeah, I'll see everyone in the, I don't know, near future, and if I make any more of these videos, sometimes you think the video is gonna be short, but man, Jesus. Oh, E-mini, you can see E-mini, again, it's all in the bear market. But anyway, man, I don't wanna keep on just babbling here, so I'll cut it short here, and I'll see you guys later.